Welcome to The Explainer. Today, we're unpacking a seriously ambitious piece of economic policy out of Vietnam. We're taking a close look at Decision No. 05/QDTG, which is this sweeping strategy that sets a really bold 2030 vision for the Vietnam Bank for Social Policies, or the VBSP. So let's dive right in and see exactly how an entire nation plans to use state-backed banking to lift up its most vulnerable populations over the next decade.
Now, signed in January 2023, this isn't just some quick memo. It's a dense, 12-page government blueprint. It literally serves as the official, legally binding roadmap for funding social welfare and driving rural development all the way through to the year 2030. It outlines exactly how the government is going to mobilize, manage, and deploy billions of dollars directly to the people who need it the most.
To make sense of all this dense, bureaucratic text, we're going to break it down into 6 bite-sized pillars. The 2030 vision, securing the funding, empowering vulnerable communities, modernization and tech upgrades, risk management, and finally, executing the strategy.
Section 1. The 2030 Vision.
The government has set some highly ambitious macroeconomic targets, and it starts with this number, 10%. The strategy strictly mandates an impressive average annual credit growth rate of around 10% for the VBSP. I mean, just think about that for a second. For a state policy bank to grow its credit deployment by 10% year over year, that requires a massive, sustained scale-up of operations. It means constantly reaching further and further into the margins of the economy to provide new loans year after year. But here's the catch, and it's a huge one. While growing that aggressively, the bank is strictly required to keep its overdue debt ratio under 2% of its total outstanding loans. This is an incredibly tightrope to walk. To put that into perspective, a lot of traditional commercial banks have higher default rates when they lend to prime borrowers. Yet the VBSP is being told to lend to the poorest, most vulnerable demographics, people who usually don't have any collateral at all at a high growth rate, while simultaneously keeping bad debt practically non-existent. It requires some absolutely remarkable financial discipline. So, why take on this massive financial tightrope walk? Well, because the goal isn't just to build a profitable bank. It's to weave an inescapable safety net. It all connects back to the ultimate promise outlined in the decree, guaranteeing that 100% of eligible poor households and policy beneficiaries actually get the financial services they need. The vision here is to ensure that absolutely no eligible family falls through the cracks. Section 2. Securing the funding. Of course, a grand vision like that requires some seriously deep pockets. The decree establishes stable capital allocation rules, and the first massive funding anchor is 30%. By 2030, the national state budget is targeted to make up 30% of the VBSP's total capital sources. This locks in a heavy, long-term commitment directly from the central government's coffers. But it's not all falling on the central government. The decree introduces a really interesting localized mandate, too. Entrusted funds from local, municipal, and provincial budgets are mandated to make up 15% of the total capital. And this brilliantly illustrates a shared responsibility model. It essentially forces local governments to actively invest their own budgets right back into their own local poverty reduction efforts through the bank. When you stack these funding streams next to each other, a really fascinating structure emerges. On one side, we've got public budget allocations, that 30% state and 15% local mandate driving almost half of the total capital. But on the flip side, the decree is also relying heavily on market and philanthropic sources. For example, it actually mandates that state credit institutions have to maintain a 2% deposit balance with the VBSP. It also tasks the bank with mobilizing social and philanthropic funds. So it's this very deliberate, clever blend of heavy government commitment supported by real market mechanics. Section 3. Empowering vulnerable communities. Okay, so with the funding locked in, who exactly is this money for? The decree doesn't leave any room for ambiguity here. It specifically lists the exact demographics that these credit programs need to uplift. We're talking about poor and near-poor households, ethnic minorities living in remote mountainous regions, rural workers who desperately need capital to develop their livelihoods, and other vulnerable groups in extremely difficult geographic areas. This entire strategy is tailor-made to reach the exact people that traditional commercial banks usually ignore. And looking right at the source text, their strategy is crystal clear. The VBSP is legally instructed to roll out distinct preferential interest rate policies. It specifically dictates that the level of preference should be the highest for ethnic minorities and those living in exceptionally difficult regions.
Basically, they are actively lowering the barrier to entry by subsidizing the cost of borrowing for the people facing the steepest uphill battles.
Section 4. Modernization and tech upgrades.
Now, you might be wondering, how do you actually deliver these tailored loans efficiently to people living on remote mountaintops? Well, it takes a massive technological leap, which the decree defines as digital transformation, or chuyển đổi số. In this specific legal context, that means totally upgrading the bank's core IT infrastructure and diversifying their digital products. But it comes with a really strict caveat. The technology has to ensure safe, convenient, and most importantly, low-cost access tailored specifically for rural users. It's all about heavily modernizing the back end while keeping the actual user experience incredibly simple and accessible for someone who might just be using a basic smartphone in a rural village.
Section 5. Risk Management and Supervision.
Look, whenever you mix rapid credit growth, highly vulnerable borrowers, and brand new digital systems, you're going to introduce risk. There's no way around it. So to build a safety net for the bank itself, the mandate requires the development of sophisticated early warning systems for credit risk. It also strictly regulates exactly how the bank classifies and provisions for bad debt. The decree insists on total transparency and making sure there are sufficient resources to handle bad loans openly. It's a very clear acknowledgement that if they want to maintain that aggressive under 2% bad debt ratio we talked about earlier, they absolutely need highly sensitive tripwires to catch any problems early on.
Section 6. Executing the strategy. At the end of the day, a plan is only as good as its execution, right? To make this whole thing a reality, the decree assigns very specific homework across the government. The State Bank of Vietnam is tasked with overall state management and rigorous inspection. The Ministry of Finance has to handle the legal frameworks and actually guarantee the bonds to raise the money. Local committees are legally on the hook for their budget allocations and on-the-ground oversight. And finally, the VBSP itself is responsible for the direct execution and drafting out detailed 5-year operational plans. So everyone has a very clear, legally mandated lane. And it all officially kicked off right here. This is the signature of Deputy Prime Minister Pham Binh Minh. The second he signed this decree, the policy was enacted. There was no waiting period. The clock is already ticking, and the vast machinery of the Vietnamese state has been entirely directed toward this singular 2030 deadline. So we've gone through the targets, the funding mechanics, the target demographics, and the sheer technological ambitions. And I want to leave you with this final thought. How will this comprehensive financial and digital overhaul fundamentally reshape Vietnam's rural economy by the year 2030? If they can actually successfully balance that aggressive 10% growth with the strict sub-2% risk threshold, the real-world impact on bridging the wealth gap could literally be monumental. Thank you so much for joining me for this explainer, and as always, keep questioning the frameworks that shape our world.